Welcome to Universe's Total Portfolio Podcast. I'm your host, Ron Lagnado. Our series explores essential topics for investment professionals with a focus on asset allocation and risk mitigation. We feature experts on our episodes who share their insights to help investors make better decisions that improve performance. Today, we're pleased to have Elisabeth Bourqui as our guest. Elisabeth is the CEO and co-founder of PNYX Group in Lausanne, Switzerland. Among her prior roles, she was head of pension management for the multinational ABB Group. She holds a PhD in mathematics from ETH, the Swiss Federal Institute of Technology. In today's podcast, we'll hear about Elisabeth's experience and approach to portfolio management, with a particular focus on the so-called total portfolio approach and her views on tail risk management. Elisabeth, it's great to have you on the show.
Wonderful to be here. Thank you, Ron.
Well, before we dive into our main topic, please tell us a little bit more about your background in investment management, particularly your success at the ABB Group. My recollection is that you inherited a very underfunded corporate pension plan, and in a matter of a few years, you took it to almost fully funded status. And also tell us, about your firm, which is relatively new.
Wonderful. Thank you, Ron. Was since 2011, I think, for a while, the CIO of the ABB pension funds. There was about 100 different defined benefit pension plans all across the world in different jurisdictions, right? Each of them had their own board of trustee from a governance perspective, right? And all of them had different liabilities, different maturity, and different type of asset investments. The assets were not pooled, right? The plans had different funded status conditions, right? Some of them were underfunded, some of them were overfunded. It depends as well, of course, on the different reporting gaps, depending if you report under US GAAP or if you report under the local gaps. But all in all, there was a global situation as well from a holistic and total fund perspective to manage. And what we have done was to kind of consider each of the different pension plan and their funded status per se individually in their own context of objectives and jurisdiction, and then considered them all as a total fund portfolio, if you will, and tried to kind of make sure the whole thing was kind of the whole total fund would kind of pursue its objectives. We tried to kind of bring them all at a funded status, which was fully funded, right? And so at that time, overall, they were at a 60% funded status, and we brought them to almost a fully funded status in about 6 years. We did that without necessarily injecting, cash capital into the different various funds, neither from the employer side, neither from the employee side, which was very good. And the way we did it was to use a special technique of total fund management in terms of understanding of the risks and traditional and non-traditional risk. And the other part was to kind of use a technique around dynamic investments, a form of dynamic asset allocation, which was pretty sophisticated on that. So that's what we have done. And to your second question on the PNYX Group, right, which I have co-founded and started 5 years ago, right? We have had quite a success. We work essentially with sovereign wealth funds throughout the world and large public pension funds as well. And the same thing, trying to kind of bring a total fund portfolio management view, and both from an opportunities point of view and an investment point of view, and from a risk point of view, into those systems and enhance the system and align those systems towards their objectives and their goals.
So it's pretty clear that you're already a practitioner of the total portfolio approach. So this is a term that has drawn considerable attention recently and appears to be gaining traction among U.S. pension funds. So I would sort of broadly describe it as a holistic and flexible framework for portfolio management. that differs from the traditional strategic asset allocation. It appears to be more dynamic than traditional SAA. And a key element seems to be that each potential investment is evaluated based on its contribution to total portfolio risk and return, rather than how it fits into a specific asset silo. So that said, let me just turn it over to you to hear what your thoughts are on what TPA is or should be and how it compares with strategic asset allocation.
Thank you, Ron. And you said a very important word just in your sentence before, which is the silos of the assets or the asset classes, right? And I think this is the starting point of the reflection and of the methodology here, right? Often, large complex portfolio from a large public pension or a large corporate pension or a large sovereign wealth fund or a large endowment, right? They are most of the time they have a strategic asset allocation and they have different buckets, right? In terms of asset class buckets. So they have an allocation to equity, an allocation to fixed income, an allocation to private markets, infrastructure, private equity, to hedge funds, etc. Right? Obviously, this is relatively siloed in the industry, and I'm saying that with, I would say, a sweet and sour tone, in the sense that there are good things about that, in the sense that you have fantastic professionals in all of these silos, right? That do a very good job within their own asset class. Of course, there is a sort of other side of the medal, right? A sort of reverse side of the good side of the thing, which is silos of investments and silos of risks within those asset class. And sometimes it's very difficult to breach those asset class. And total fund portfolio management is really about crossing those bridge of all what is cross assets, which is an overall portfolio nature that is so important. So I give you a very concrete example, right? Most of the time you have cross asset. Recently, we have, for example, an asset class which is private equity infrastructure. So meaning infrastructure underlyings, but really organized from a return and risk perspective as a private equity type of asset. So it's typically something between a private equity silo and between an infrastructure silo. There are very good opportunities into that, very interesting risk to take, very interesting risk as well not to take. And it's very important to take those cross-asset nature into consideration within a total fund. We had that in the past. I give you this was a recent example, but in the past we had also other example of such cross assets as well, like, for example, convertible bonds and things like that. So that's just cross asset. But you have as well other important issue is what do you do with hedging, interest rate hedging, but also, of course, equity hedging or hedging against volatility, and how do you manage your tail risk from an overall perspective, right? And that is not easy to do when you have a complete siloed feature of your whole investment office, I would say, and your investment processes that goes with it. And what we have defined at PNYX was that background and that track record coming from before, right? But is defined methodology that permits to somehow break the silos, right? And go beyond that.
So let's get more into some of the technical details. So, whether you're talking about TPA or SAA, in the end, you have to somehow decide how to allocate to assets. So what would your approach be there? Does it involve some type of optimization? So how do you actually begin to construct a portfolio even within the TPA framework?
Absolutely. Thank you very much for that. So I think the methodology is for me in 4 steps, right? And we have defined it at PNYX, right? One is really to define the objectives and the constraints of the constraints of the fund, right? What are really the objectives? So objective on a pension fund is, of course, to get to fully funded status when it's underfunded. When it's overfunded, you have also very unique and very specific objectives, right? As an overfunded plan. When you are a sovereign wealth fund, you have objectives which are linked to the sovereignty of your sovereign wealth fund or your sub-sovereign wealth fund. And when you're an endowment, you also have very specific objectives. So the first thing is really to think of a strategy that align those to those objectives now, but also over time. The second step, and it's what I call a bit the values and the identity. There is the notion today of identity of a fund, of an institution, that is a bit underestimated. And that is crucial for total fund management, to really think what's the identity of this sovereign wealth fund, what's the identity of that large public pension fund or that large corporate pension fund, and to do investments that are aligned with that identity, right? It looks very vague, but it can be very, very technical, because there are some identities. For example, if I take, let's say, a sub-sovereign wealth fund from a province in Canada, right? Here you have an important identity of the province itself, right? And you want this sovereign wealth fund to create wealth for the future generation. So in 100 years time frame, which correspond to the whole economy and to the whole identity of the province. So the province has a very specific identity of its own, a very specific culture, pragmatic, being conservative, for example, and things like that. And you have to take into account that for the investment strategy, because if you don't, you come up into investment strategy which are invested somehow into things that do not fit and do not make sense according to the culture of your own investment office, right? The third step after this objectives and constraints and values and identities is what I would call dynamic investment. It's really to have a dynamic asset allocation across the total portfolio management that is extremely structured and well-defined. And for this, for me, there are three keys. It must be measurable, it must be quantifiable, and it must be repeatable process in order to kind of surf the waves of the market and surf the waves of the different regime shift, and doing dynamic asset allocation in a very structured, measurable, repeatable, and quantitative way. The fourth pillar, I think, of this total fund portfolio methodology that I think is crucial is to have forward-looking views, scenario-based forward-looking views, and not backward-looking, of course, right? So it's very important to take into account the historic nature and quantitative, sophisticated nature, of course, the different things, but it's important to go forward-looking about the world and about the risks. And I give you a very simple example. I have, for example, a bit of, let's say, a few convictions today in the world, right? If I think of the market, I think one of the conviction is that governance performs, right? That when you have companies, portfolio companies or institutions, right, that are well governed and governed in the sense of efficient decision making, and that the organization is very efficient on that way, right? From a quantitative and qualitative perspective, this performs. So it's very important to invest into those, right? And I have a conviction that governance performs, and that is a drivers of investment performance and a driver of investment risk, right? So this is a bit of a kind of non-traditional factor. Another conviction is that we live today in a world that is much more dispersed in terms of winners and losers. The dispersion is completely different between, like, let's say on the stock market, the winners and the losers have been spreading across, meaning that the whole passive investment world, which I like. I mean, I like passive and active investment management styles, but I think there will be an issue in the world going forward with these winners and losers that kind of get dispersed more. And this is a new form of non-traditional risks and also opportunity. The third and last conviction, to make it simple, that I see is somehow that we live in a world of rise of conflicts. So obviously, rise of geopolitical conflicts, but I'm speaking more about other type of conflicts. For example, values conflicts, intergenerational conflicts between young and old people, or values, for example, ESG, anti-ESG type of values, etc. Right? And this makes changes into your point. The reason I'm speaking about those convictions is that it brings new forms of risks and opportunities and new forms of factors. And it's what I call traditional factors, traditional risk factors, and non-traditional risk factors, such as governance or such as geopolitics or such as dispersions in the market. And what is important is to do a forward-looking estimation and a forward-looking view of those traditional and non-traditional risks in order to do a proper total fund portfolio management. And that is the fourth dimension of what I just said before, of the four dimension of total fund portfolio management.
Well, that's very interesting. That sort of gives a very broad-based definition of what TPA is. But getting back more to detail, at some point you have to make initial decisions about how much to allocate to equities, how much to allocate to fixed income, even though you're not following a siloed approach. Again, is there some form of optimization that's used to assign those initial allocations? And furthermore, how do you actually measure risk in the portfolio? Do you use volatility as a proxy for risk, or do you look more at, say, drawdown as the risk that you want to minimize in the portfolio?
Wonderful question. Thank you for that, Ron. And let me go a bit more into the detail of these four pillars methodology that I have just explained. I'll take to start with the fourth pillar, right? I think from a total fund portfolio management, what is important is to do an assessment and a forward-looking assessment of the traditional and the non-traditional risk and opportunity factors of your portfolio. For instance, thinking, okay, what are the 5 drivers of performance somehow? Is that kind of growth factors? Is that value factors, to take traditional type of factors, but also is that non-traditional one? Where are the places where the governance will perform more? Typical, I give you an example in private equity, right? Private equity, everything is a bit based on the governance, right? You impose in a portfolio company a new form of governance, right? Which is speeding up processes and bringing that up. Of course, maintaining an important capital structure, a certain integrity, a certain values of the company, etc., brings this asset more prone to perform thanks to a good governance. There are other examples like that across asset classes. So the idea is to assess those traditional and non-traditional factors. Once you have assessed those across the different asset classes, to respond to your question, I use a couple measures of risk, right? I use volatility, of course, but volatility is a bit too normal and too standard deviation and too simplistic. I use really a measure of tail risk, which is the CVAR, the cumulative VAR, right? Which is everything what you have as a tail risk after the, let's say, 5 percentile of the worst case scenario, 1 in 20, for example, right? So it's about the worst case of your asset class, of your portfolios, of your different segregation of the portfolios, right, into that CVAR. And then what I do is that I use what I call CVAR Sharpe ratio. So I do Sharpe ratios, forward-looking, of all the different asset class, sub-asset class, traditional asset class, non-traditional asset classes, and try to kind of organize over the 1-year period, 3-year period, 5-year horizon, 7-year horizon, 10-year horizon, 20-year horizon, right? I do projection according to scenarios, quite sophisticated, of those CVAR Sharpe ratio for each of the asset class. And then I compare, or each of the sub-asset class, or each of the traditional asset classes, or non-traditional sub-asset class And based on that, based on these C-VAR Sharpe ratio, I make a sort of distinction on which one are good entry point in order to enter in, or good exit points of those asset class, sub-asset class, traditional, non-traditional asset classes. And based on that, I evolve it into a process, which I call repeatable and measurable process of dynamic asset allocation based on that measure.
Turning to this notion of dynamic asset allocation. So, under traditional strategic asset allocation, there's this generally a process of always rebalancing back to the target allocation. These target allocations are believed to be, the true correct allocation, for the duration of the investment horizon. Of course, in practice, pension funds revisit their strategic allocation, after so many years, but it's still a relatively static asset allocation process. So one of the hallmarks, I guess, of total portfolio approach is this notion of being prepared to dynamically allocate and not simply just rebalance back to fixed targets. So what sort of process drives that dynamic allocation? How do you actually assess changes in market conditions that would cause you to make adjustments to the portfolio?
Thank you very much for that question. I've always been stressed reporting to a board of trustee of a pension plan or to a board of a sovereign wealth fund that have a sort of strategic asset allocation, right, on which somehow is very, as you said, Ron, very static, right, and which is revised every now and then based on the best practice of, let's say, 3 to 5 years. There is a renewal of that static strategic asset allocation base, right? I think as everywhere, you need to have a certain base. I'm not criticizing that because it's a start for an allocation, right? But I'm very stressed myself being in a board of trustee of some pension plans, but also when I report to some others, right? To say, hey, we run the risk of sitting a bit onto something on which we always find views about the status quo because we don't have a crystal ball in the future. Our world is very disruptive and therefore still maintaining the status quo. I have today no real specific, very strong conviction about something to make me change from that status quo. And that is, of course, kind of very dangerous when you start to kind of do rebalancing, because then you have a whole staff, a whole investment office, which is rebalancing to that status quo. And I think it's always very important to challenge the status quo. So the total fund portfolio management and the dynamic asset allocation that comes with it is exactly about challenging that, I would say in a constructive way, hand in hand with the board of trustees on that. So to be very concrete, what that means is that it's about going from checking and validating the neutral rebalancing, so the rebalancing to neutral, to other form of smart rebalancing, either within a bandwidth or either within a certain form of regime shift going on in the market. So what this means exactly, back to the methodology I was explaining just before, is that according to the different asset classes and sub-asset class, which are traditional and non-traditional, you kind of do forward-looking projection over the 1 year, 3 year, 5 year, shorter time frame horizon of those asset class, and you kind of based on those C-VAR Sharpe ratio, so tail risk type of Sharpe ratio, and from there you determine what would be the best allocation, and you always compare those to the neutral rebalancing, and the neutral rebalancing you also project it according to those forward-looking projection, and so that you can compare basically apple to apples in the sense that you do those C-VAR Sharpe ratio for the neutral rebalancing and you compare it for the other form of dynamic rebalancing or smart rebalancing that you are trying to do. And you compare those and you make a decision, but again, a process-driven decision on that. And the process is based, of course, on the scenarios and the conviction I just said before, on the convictions of your scenario and the conviction on the market, depending if there is a regime shift, either from a traditional regime shift, for example, a central bank policy change, a monetary policy change, but also a volatility period type of change. I'm thinking of volatility and like artificial volatility being put in the market a lot. And how do you kind of get along with that? That's also a regime shift. As I said before, a regime shift which is more of a non-traditional nature, for example, on the governance side, or from a question of a rise of conflicts and geopolitics.
So it sounds like you've moved well beyond the old mean variance framework to one that's much more sensitive to actual tail risk, through your use of conditional value at risk. So getting to this issue of tail risk, what actual strategies do you recommend to your clients for mitigating tail risk, or how do they actually go about that? And clearly, for most of them, equities must be the primary driver of both return and risk, correct?
Absolutely. And thank you for your question. You said a very important buzzword, which is the mean variance framework. And I would call it also the Markowitz framework. I think we have seen in all the crises that we have been through in the last 2 decades, right, that the Markowitz framework is great and the mean variance framework is great, but it's not really bringing, it has not worked, right, in any of the, in any environment, for the simple reason that we do not work in an efficient market. We are in a highly inefficient market, right? And therefore, there are certain things that are not being diversified, and the diversification has not worked because it was linked only to traditional factors and not to non-traditional factors. So I think we cannot sit on that Markowitz framework anymore, and we need to go. The question is a bit, where do we go from there? So to your point, I very much like the tail risk thing and the tail risk on traditional and non-traditional factors. And that for me is really important. And as I said before, I'm repeating a bit, but it's a bit sophisticated. To get out of this mean variance framework for me is to think about non-traditional risk from a forward-looking perspective with CVAR-Sharpe ratio again. So the idea is to have a quantification somehow of that tail risk for an asset class or a sub-asset class according to those non-traditional factors, project it, and then address that risk. And to address that risk, you can either work on the allocation, but you can work as well on other things like tail risk hedging or things like that. So let's give a very concrete example. I've been working a lot because it's an important asset class that has become very important, which is private credit. Just to give an example, among other asset class, how do you deal with private credit? I've been thinking, private credit is a strange animal asset class, right? There is a lot of sub-asset class in there. You have a lot of different private credit, different things. You have bank loans, you have different type of loans. I have thought, for example, about one example, which is family business private credit. So it's an investment strategy that does private credit, but only to family businesses, right? This is very different. It's a sub asset class. And when you think about it, this asset class is very different from the rest of the private credit as a sub asset class from its tail risk. Why? It's that when you lend money to a family business, it's very different than lending money to a corporate large-listed business. And why is the case is that families, right, when they run their own business, they have a 100-year time frame. They have a very unique governance, which is very different from a listed company governance. And they think about all the succession, how it's going to go, how to kind of bring a governance that is being, for example, staying very independent, not bringing leverage in, but still bringing capital and new form of capital into it, etc. Hence, private credit to family business. They have a completely different way of interacting as the rest of the credits or the rest of other organization. And therefore, when comes a crisis, a family business private credit is very different from a tail risk perspective, right? Because the the recovery ratios, right? And on those companies, right? And the whole governance efficiency of the process within those companies is completely different, meaning that your way to recover very quickly, and especially on the credit side, is very different. So your credit is very different. So here, if you think about that from a non-traditional perspective and with the non-traditional factor of governance, and you quantify that into your measurements, you get to a very different tail risk than the rest of the private credit. You have like private credit on the bank loans and stuff like that would have a certain tail risk attached to it on the default side, on the recovery side, on that kind of things, right? On non-performing loan side, etc., right? And you would have another form of tail risk in the context of the family business credit. So it's that kind of tail risk that I'm thinking about. And once I have a sort of clear mapping across asset class, sub-asset classes, across traditional factors, non-traditional factors, I just gave an example here around governance, non-traditional factors, you can map all this around the total portfolio measurement system, of course, all digitally, etc., so to be efficient and quantitative. And then rethink of your tail risk like that. And then you can take decisions of what type of tail risk you want to take, not take, and how are you going to mitigate those. And those techniques would be to allocate more, let's say, to family business credit, because you want to take the risk of the family's type of tail risk, but you don't want to take market risk, for example, or you don't want to take technology risk or things like that. And you would hedge those kind of other tail risk, for example, in the context of tail risk hedging through market risk type of hedging. And that's the way I address the tail risk, back to your point.
So just last question, staying on this topic of equity tail risk, as it's practiced by Universa, we employ a very highly convex tail risk strategy that's based on option positions. Have you seen that or encountered that before among your clients, or do you see interest in that? One of the advantages of this type of tail risk hedging, which specifically focuses on equity tail risk, is that, under traditional diversification, which you mentioned, it doesn't really do a good job of actually adding value across a drawdown cycle. So typically what happens, for example, during the COVID pandemic, there's a shock, the equities dropped, they fell roughly, S&P was down maybe 20 plus percent. During March, if you had a large allocation to bonds, it helped in offsetting that mark-to-market loss. But then typically with these sharp drawdowns, there's a sharp recovery, and those bonds basically give back the gains. Nothing's monetized, nothing's locked in. So is this something that you think is of interest to your clients? In other words, find better ways to actually not only protect against equity crashes and equity tail risk, but to actually take advantage of them. Warren Buffett's investment strategy throughout his career has been always to have sort of dry powder available so that he can, pounce on the opportunities that arise in a big market sell-off. His approach to maintaining that dry powder had to do with, the cash flows that he had from the businesses that he owned. But in tail risk, for example, it's tail risk hedging through option strategies. You have this way of producing liquidity, at the time of market stress. And with that added liquidity, you can then reinvest it in the market so that you have, come out better off after the drawdown than when you went into it. This is something in my experience that does not happen well under traditional portfolio management with diversification with bonds. There's literally a timing call that has to be made when to decide when you sell those bonds and lock in their gains. And it almost never actually happens, with typical rebalancing strategies. So is this something you've thought about or have interest in?
Absolutely. Absolutely. Thank you, Ron. And for me, there's a bit two things about that. So first of all, yes, I see that with my clients, and it's a very important thing. I believe a lot into tail risk hedging and what you could do it from both a risk management perspective and an opportunity investment perspective, right? I see that very clearly. I think there is two aspects for me in what you say is what you can actively do with that, and what as well you can foster with that within an organization. So I explained myself. There is really the acting on it, which is of course and obviously very important, and especially in the disrupted world in which we live. Again, I have a conviction that we live in a world of winners and losers, and that makes it the sort of rebound effect when there is a crisis, right? We always take into account that everything comes back like a V curve or a U curve, and there's lots of theories around that. But in a world which is more dispersed, I think there are things that comes back as a V curve and things that do not come back as a V curve. The fact to have that reflection and to kind of be able to act on that part that act as a V curve, and that then using the liquidity that you produce with that in order to be able to rebound and have the dry powder at the right time. This is what people say market timing, but it's not. It's fundamentally making use of that volatility, right? It's really making use of that volatility, and from a risk management standpoint, but also from an investment standpoint. So I think you can really act on that, and it's extremely important in portfolios to act upon that. And it's something on which it's important to have those kind of strategy in advance in a portfolio, because when the crisis comes, etc., board of trustees and the pace of things within the board of trustee is not adequate for that, and you need to be very well settled on that. But I will say another dimension of that, just the acting part of it, but the simple thing of discussing about these things and understanding really your tail risk and which one will kind of have a V curve and will rebound, and what type of liquidity you can get in the worst moment, and how will the correlation will look like, and what is it across traditional market risk factors, but how is it around non-traditional factors as well, right? Just the simple fact to have those discussions enhance overall and whole investment office across asset class and across the silos of the asset classes, and enhance of what the investment office and staff bring to the board. And those discussions are extremely valuable for the reality of the funding ratio. The simple fact to have those discussions and to grow smarter together as a team, right, is very important, because it sets us in a framework which is going away somehow from the Markowitz framework, which is a good framework, but it's dating from the 50s, right? We are in 2025. We need to kind of evolve with where we are and the reality of where we are. Market and are inefficient, right? There are dispersions as never seen. Governance performs, right? Tail risk is there. Correlation do not correlate in crisis times, right? And all of these factors, right, have to be brought into the equation, and that brings and enhances the level of understanding and conversation within an organization. And it's very, very useful and very important to have them.
Well, thank you. We've come to the end of our show, and I'd like to thank you for your insights, helping sort of clarify what the total portfolio approach is, even more so the very detailed and specific examples that you gave. So thank you, and we hope to have you back again sometime soon.
I would love to. Thank you very much, Ron, for this. It's really a pleasure, and I would like still to end on something to everyone listening to that podcast. I mean, tail risk, traditional and non-traditional tail risk on a forward-looking basis is one of the most important things you can do on the total fund portfolio management.